when you make, let's say, 20 pips, that's about $6 on the table. And now let's say you opened up 2 trades, you have $12 on the table already. So you see how important this is? Now, I clearly understand that most traders struggle a lot with small accounts. They blow up these small accounts and sometimes they panic and end up going for prop firms and still do the same mistakes over and over. Now, the funny thing is, if you can't manage a small account, then you can't manage a big account. So in today's video, I'm going to break down a system that I used to turn my $250 to about $60,000 in a span of 9 months. And by the way, that's 2 years ago, and I've actually been using the same system for the previous 4 weeks because I needed to know if it's still working. And guess what? The results have still been insane. I've been trading on about $100, $150, and even as small as $50, and I've actually been making up to 50% of the account, 80%, just like what you guys can see in here. So I'm going to break this down for you. Now, the first thing is we need to know the instruments that you should trade and you shouldn't trade on your small account, and you also need to know the trading sessions. So obviously you shouldn't look at trading volatile instruments. This can be gold, Nasdaq, US oil, US 30, silver, and any volatile instruments, because these pairs could actually make you a lot of money, and then in the shortest period of time your account could easily be blown. So when you are looking at consistency, those may not be good pairs. I've actually had a lot of people complain, and it's the same mistake over and over. So don't trade these pairs on your small account. And then the other most important thing is the trading sessions. Now you need to trade sessions where most traders are in and the moves are actually big, because like how we are going to discuss, you need to get those big moves on your small account as long as you are looking at making money off it. So you can consider the London and the New York session. And to any of you guys who may not know me, my name is Daniel Achirize. I'm a full-time day trader, and smash that subscribe button. Now let's dive straight into the system. Now the first thing is trade like a casino. Now how does this even happen? So regardless of how many people are gambling in the casino is going to make money at the end of the day, and you as a trader, you should make money at the end of the day, because that's the objective. So how does this happen? The casino has an age, and you should have an age. So let me show you how this happens. I'm going to do an illustration of how this actually happens and how you can actually use it to your advantage. Okay, so we are going to take a sample of 10 trades. And now here's what happens. So when you take trades and you have a trading strategy, let's say that has 60% win rate, right? So that means out of 10 trades, you have 6 winners and then 4 losses. And now this is your age. So 6 minus 2, it means you have 2 winners at the end of the day. And in the worst case scenario, let's say your trading strategy has a 50-50. It means you have lost 5 trades, that's 5 losses, and then you have made 5 winners. And then in your trades, it means you have 0. But then later on, we shall actually see how you can do this to your advantage. So that's where the age comes in. So your trading strategy should have an age for you as a trader. So just understand that every time you come to charts, you know that, okay, I'm going to take, let's say, 10 trades, and I clearly understand that, well, my trading strategy has a 60% win rate, and I look at making 60% and then losing 40%. Now, this is why it also comes back in. So again, on the other side of a risk management, the lowest thing that you should look at on your small account should be at least 1 to 2. So we call it 1 to 2 RR. So what does this mean? So 1 to 2 RR means you are risking 1. So you are risking 1. Okay. And you are looking at making 2 reward. So meaning for any trades that you open, at least have a 1 to 2 risk to reward, because at the end of the day, going back to our age, let's say you had 5 losses and then you had 5 winners. you make money, because now at the end of the day here you have a total of 5, and then this side you have a total of 10 wins. So getting the 5 losses minus the 10 wins, you have 5 winners sorted out. So this is so important. So in any case, look at a minimum of 1 to 2. You can also go for 1 to 3, 1 to 4, and in the best trades, like how we shall see, if you can get even up to, let's say, 1 to 5, then kill it hard. But it's very important that your reward should be bigger than the risk in any case. Now let's go ahead and actually see how you can capitalize on this. So in the long run, you are going to be consistent and you are going to make money. So let's say you are trading off with $100. So you are trading off with $100, and then you have, let's say, a risk to reward ratio of, let's say, 1 to 2, right? RR. And let's say on your trading account, you risk, let's say, $1. Okay, let's say $1. And then you are making $2, right? So meaning in 10 trades, considering the 60 to 40, right? It means you have 6 trades, 6 winners, that being 6 times 2 reward, and that's 12. Then with your losses, 40%, that being 4 times 1R, that being about 4. And guess what? You have made money. So your age really matters a lot. And as a trader, you should maintain this and keep it every time you have trades open. Now, the second thing that you need to do is kill it hard. Now, every time you have that chance and you have some good trades, well, kill it hard. Now, let me show you something. So here's what most traders do. So some traders are going to close their trades very quickly. Oh, well, I'm panicking. I don't want to lose my money and all that. And I've made some money. Let me close it off. So let's say we had a trade and then we had, let's say we bought right around here. And well, just because you have made some money right here, oh, you start panicking. Let me close off my trade. And yeah, you're going to close off and then the trade is going to keep going. Yet you could have actually made all this money. But I'm going to show you how you can actually go about this. Then the other side, some other person is going to be in a drawdown. Let's say we have this. So let's say you opened up your buy here expecting the price to push up. And now what happens is the price breaks through and then it keeps coming down. Now, in this case, this person, okay, I think let me just keep holding my trade because it could actually later reverse. And guess what happens? You keep holding your trade as the account keeps going and then it's blown, right? So don't do this. Now, here's the best way on how you can actually kill it. So we have what we call scaling in more positions. Now, this is a very, very important skill set if you are trading on a small account and you really want to make big money on it. So here's what happens. So let's say we have a very, very good trend. Now, I can't stress this enough, but if you are looking at making money in the long run, you need to trade with a trend because you are trading with most of the institutional traders because the trend is already established and all you have to do is dive in, right? So going back to example, so let's say you have a clear uptrend. So here's what is going to happen. So let's say we opened up a buy right around here. So we opened up a buy and the trend is pushing to the upside and more. Now we have these points here. We have these points here. And that's what we should always scale in. So look at the end of the pullback and then look at how you can open in more positions. Now, some key points to really mark out. Most importantly, when you are scaling in, you shouldn't do this when other trades are still in losses. Let's say your first trades that you opened are still running in losses. Don't scale in more positions. This is so important. And then the other thing is, so the first thing being don't scale in more positions when the other trades are still in negatives. And then the other thing that you should mark out most importantly is use smaller lot sizes as compared to the ones that you opened up at the start. So let's say your first trade at first was 0.1 lots. When you are scaling in more positions, use let's say 0.03 or 0.04. At least let it be smaller than the lot size that you entered at first. Now, how does this help? So this is going to be so helpful on avoiding the drawdowns because let's say you have your move that had actually started and you had money. And then when we come for this pullback, we are obviously going to come into a small drawdown, right? So we have a drawdown. Now, when you open up here a bigger lot size as compared to what you had opened before, well, that's some emotional breakdown, and now you're going to be under control of your emotions because you had money already, you had made money already, and now you have opened up bigger lot sizes, and it means now your account is back to reds. And I don't want you to fall for this mistake. Just look at smaller lot sizes every time you are trying to scale in. And then most importantly, wait for the other positions to be in profits and then scale in more positions. Now, how do you know that the pullback is ending? So we need to also understand this clearly, because you don't have to just, oh, well, Daniel said scale in more positions and do this and that. No, here's what you're going to look out for. So when you are looking at a closure of a pullback, you might need to see the candlestick patterns. Well, let's say we were in an uptrend, just like our first example, and then we had a pullback, this being a red candlestick, right? Try to look out for something like an engulfing candlestick. Is this candlestick showing some change in momentum that now we are back to the normal trend? And well, when you have this, you need to wait for the second candlestick, because in any case, you shouldn't panic. You are trading on a small account, so you need to get the best and the high probability trades only. So all you're going to have to wait for something that is going to confirm that, okay, now the pullback is done and now we are going back to the original move and now scaling more positions here. And then you are going to place your stop losses just a few pips below these entry points, meaning if you entered your buy right around here, you could place your stop loss about 20 to 15 pips just below these levels. This is a very, very great way of killing it so hard, because you have a very small stop loss and then you also have many trades running. And the other thing that you can also implement in here is moving your stop loss to break even. This is a killer strategy. So here's what happens. So when these trades start getting into profits, now you are making money. You are making money. Now start adjusting your stop losses. So let's say your first trade was right around here and now you have made money. So all you have to do is adjust this stop loss to somewhere around here. Let me get this off. Okay. Once again, so let's say your stop loss was initially right around here and now you have made some money here. Just bring your stop loss up to around here. And now the more you keep getting into more profits, keep extending it. So the more you extend it above, obviously now you have this money guaranteed. No risk. This is money that has been made and no one is going to take it away from you unless you decide again to change. But this is already money that has been made. So you can always consider moving your stop losses to break even as you scale in more positions. As you make money, keep moving your stop losses. Or the other option is closing off partial positions. This is a good one. Let's say if you had three positions running, you can decide to close one or two, so you have the other ones running. Now that means you have actually made money and you are also still making money. So either way, you are winning. Now that brings us to the third point, risk management. Now this is so important. As long as you are looking at consistency and staying in for the longest time, risk management. So here's what happens. So we have the standard risk management rule of risk 1% to make 2%. But I clearly understand that this doesn't work for small accounts. Let me show you. So let's say you are trading off with $100, right? Now $100, 1% of $100 is just $1. And now the rule says you are going to risk, let's say 1% to make 2%. And that means you're risking 1%. You're risking $1 to make $2. Well, this is very okay, but to trading, this is not going to motivate a trader. Now, I'm saying this from my personal experience because I've gone through this same experience and I've actually gotten better ways on how to go over this. So when we are trading on small accounts, we might need to go aggressive. Now, let me share this. So aggressive trading is not basically you risking your whole account because you want to make a lot of money. No, this time around, what we are looking at is you can decide to, let's say, risk 5%. 5% of your $100 and you look at, let's say, making 10% because the account is small already, so you need to make money off it. So here's a more realistic example. So let's say we are trading off with $100. The maximum lot sizes that we should use here can be 0.03. don't exceed 0.03, 0.04, 0.05. That's risky and it means you're exposing your account. Now, here's what happens. So let's say you have $100 and in the first case you used 0.01 lots. So assuming you had a stop loss of about, let's say, 10 pips. So that means you are risking $10 and then your take profit of about, let's say, 20 pips because we are looking at 1 to 2. That means you are looking at making $2. Now, well, it means for you to make $10, you might have to take 10 trades of the same type. And at the end of the day, you could end up over trading and all that. So here's what you can do rather. So we are going to look at our risk management in terms of money, not percentage. So let's say it's your $100. You can look at risking $5. And then in return, you are making $10. So what is going to happen? You can decide to, let's say, use 0.03 lots. When you make, let's say, 20 pips, that's about $6 on the table. And now let's say you opened up 2 trades, you have $12 on the table already. So you see how important this is? Now this is very good because you are not overexposing your account to risk, and in return you are actually making money. Because, well, like I said, the other way works, but it's not motivating, and at the end of the day most traders are just going to run out of patience and they're just going to use bigger lot sizes and then end up blowing accounts. So it's better to apply this risk management rule. So for any accounts of $100 and below, don't exceed 0.03. And then for accounts of about $500 to $1,000, the maximum lots here can always be 0.05. And then for accounts of about $1,000, the maximum lots can always be 0.1. Basic, that's how it is. So combining all these 3 systems, and then you are not trading the other pairs, gold, Nasdaq, US30 and the other volatile instruments, you are going to make money. You are going to kill it hard, and in any way you are going to become a successful trader. Like I said, I'm actually using this system on my small accounts, and I'm actually sharing the same processes with my student community, which you can actually be part of. So I'm going to put the link down in the description below. You can actually be part of the student community. Let's kill it hard, let's go hard together, and I'll see you in the next video. I'm out.